Hey guys, welcome back to the Trading Coach Podcast. As always, I'm your host, Akil Stokes. I just got back in the office, just turned on the computer, opened up the Tier 1 trading website, and lo and behold, there was a message waiting for me. Well, a message waiting for our community, but one that I read and said, hey, this would be a perfect podcast topic. So I plugged the mic in, put it on, hit the record button, and here we go. The question was about trading frequency, and it says, I'll read a little bit of it. Got a question for you guys. I want to calibrate my understanding of the meaning of, quote, frequent pattern. What does frequent pattern mean in terms of occurrence? Specifically, this trader is talking about the FTB strategy. It's one of the strategies that we teach on the platform called Follow the Bear. And it says, is a pattern occurrence less than one per week? And they go on to talk about some of the back testing, the results that they've done and how much they've seen. And my answer was this, and some of you may not like this, but as we always do here at Tier 1 Trading, we want to preach the truth and not give you the fluff. We're not going to give you an answer just to give you an answer. And unfortunately, in trading, there is a lot of gray area, right? We try to make things as black and white as possible when it comes to trading strategies. But in general, when it comes to performance, when it comes to frequency, there are some gray areas that are going to be based off of you as an individual trader and more importantly, you as an individual person. So I would say that there is no common definition of frequent because frequency will vary depending on a handful of things, right? Frequency can vary depending on what pair you're trading, what market you're in, what time frame you're on, right? And the strategy. For example, when you are trading a lower time frame, let's say a 5-minute chart, you're going to have a lot more frequency than someone trading a daily chart, right? Someone on the daily chart can maybe get one trading opportunity a day. Someone on a 5-minute time frame may get 5 trading opportunities within the hour. So there's going to be more frequency in there. Pairs play a role as well. And we can, if you're looking at different markets, we can say pairs, or we can say different stocks, different asset classes, because each asset class has its own individual movement, right? Some are very directional and trendy. Some are very consolidative. Some have high liquidity. Some have low liquidity. Some have massive ATRs. Some have really small ATRs. Seasonality is something I didn't mention that can play a role as well. We'll kind of put that to the side and hopefully I remember to talk about it. But you think about a pair, I was going to give a few right now, like the dollar yen. So the dollar yen is a very directional pair, meaning that it doesn't really consolidate too much. It tends to move in one direction, sometimes up, sometimes down, depending on what type of economic events are occurring. But it usually moves in more of a trendy type of direction. So if you are someone that is trading a trendy type of strategy, a trend continuation strategy, perhaps you're a pullback trader or a breakout trader, there's a good chance if you trade the dollar yen, you are going to have a pretty high frequency because that specific pair aligns with your specific trading strategy. On the other hand, we take the euro pound, which I have nicknamed the molasses pair, because if you know what molasses is, that's how the euro pound tends to move. It is very slow and sideways. It reminds me of the sloths in that movie. What was that cartoon movie with Rihanna in it? She did one of the voices. I just don't remember it because it's Rihanna. Of course, I remember it for other reasons, but I know Rihanna was in it because that voice, that voice. Anyway, the euro pound is a pair that doesn't really move too much, right? So one, it's not directional at all. So if you are a trend continuation trader, you're not going to find barely any opportunities on that pair at all. Even if you're a consolidative trader, you're not going to find a lot of opportunities on that pair at all. So that just kind of goes to showcase the difference between different pairs and how they move. We say that each pair or each asset class has its own personality. And when we're developing our trading portfolio, we want to find pairs or assets that align with the personality of our strategy. So we have time frame that plays a difference. We have asset class that plays a difference. I also mentioned that seasonality can make a difference as well. Now, I don't know if things have changed. Well, I know certainly things have changed since I first started trading because it's almost been 2 decades now somehow, right? The other day I got an email from a trader that I spoke to when he was like 17 when I was just getting started, and he reached out and saying, "Hey, my kids are this old." I'm like, "Wait a minute, what? How? What, when?" And I just realized it's been like 18 years since I've been doing this, and people grow and have families, and now I'm feeling really old about myself. But things have changed in the market, and something that I used to encounter, right? Because I started off as a counter trend trader. So most of my trading opportunities came from non-directional markets, right? So remember how I told you the dollar yen was a very directional pair? Dollar yen was not a great pair for me, right? I needed consolidation, right? I was an advanced pattern formation trader. I was a support and resistance trader. Consolidative markets where things are kind of bouncing up and down within a range. Those were great markets for me. Directional markets where things were breaking out and creating new highs and structure was failing, not so great. And I remember early on in my trading career, I didn't notice this during back testing, and it might be because I didn't really pay attention to it, but I noticed that there was a certain time of the year where my trading would suffer. And it was always in September. The month of September was simply horrible for me. And I dug into the numbers, I did some research, and I found out that, hey, the month of September, at least for specifically what I traded, was a very directional month. Now, there was a reason for that. We know that the summer is typically slow, and we'll come back to the summer in a little bit. What typically happens, right, there's the whole saying, sell in May and go away. What typically happens in September is that summer vacation is over. All of the real traders are back. I kind of like it to like kids being home alone, and they do all this stuff to the house and they mess it up and move stuff around. And then the parents come home and they're like, why is this here? Why is that there? And they're cleaning up and making sure everything is in the place it's supposed to be. The markets did something very similar, where summer was kind of ridiculous. And then September, everyone would get back and kind of restore order. And that order typically brought directional movement. And because I was a trader who was not going for directional movement, I would often get destroyed. So seasonality can play a role as well with not only trading performance, but how often you get trading opportunities. Walking back to the summer, it's the same thing. The summer tends to be slower than other months in the year. And again, a lot of people are on summer vacation. It's not a bad market. It's not a unprofitable market, as many will make you think. It's just a slower market, right? The ranges are smaller. The movement per day is less, right? There's not as much activity. So again, if you track over the summer months, you're probably going to have less frequency than, say, the beginning of the year, January, February, March, or September, October. So that plays a role as well. The point is, there are so many moving pieces that play into frequency that it would be impossible for us to give it a standard definition, a common definition. It would not be right for me to say that, well, a quote unquote good frequency is 10 opportunities a day, or a normal frequency is 10 opportunities a month, because there just is no common answer for everyone. The way that we can measure frequency is by comparing it to our results. That sets our normal. So when we do our back testing and we track data over however many years or decades that we've tracked it over, we have a baseline that says, hey, on average, I get this many trades a month, or this many trades a week, or this many trades a day. And then we can judge afterwards whether our frequency is high or low based off that number. But again, that's going to be per individual strategy. And that's still going to change per individual trader, depending on your strategy and depending on how many assets you're trading. So how is the correct way to measure frequency? Because again, yes, there's no common definition for it, but we do want to make sure we have enough frequency. And the way that I like to look at it is in terms of opportunity cost, right? I like to look at everything in terms of opportunity cost, not to go down this rabbit hole too much, but time is everything for me. It is the most important asset that we have. We cannot get it back, which makes it so valuable. So whenever I do anything, I compare it not necessarily to how much money I can make. I do like making money, and I do like making as much money as possible, but I rather compare it to what are my alternative options if I didn't do said thing. The best story I can give you is this. When we first purchased our house, We purposely purchased one with an extremely big yard because we never had a big yard. So we wanted lots of grass. We planned on having kids. I'm a sports guy. So I was like, ooh, I'll make a tennis court back there and a football field and a soccer pitch and like all these different things. It was going to be like this big complex, whatever like that. But I just wanted my kids to run around and play around, jump off trees and stuff like that versus like be on the concrete with a little kind of 2 by 6 foot patch of grass like we had when we lived in the city. And I remember when we first moved out there, and we're blue-collared people, my wife and I, and we're like, we're going to mow. We see everyone, the lawn, the landscaping services come around, and, they have the truck, and they're getting off there, and they're going around mowing everyone's lawn, and they're coming up to us and saying, like, hey, we do your neighbor's house, we'll do yours for this much. And we're like, mow our lawn? Like, come on now. Like, where I'm from, we mow our own lawn, right? And that lasted about a week. That lasted about one mow, as it took us about a week to mow the lawn. By the time we were done, the grass had pretty much grown back. And we just said it's not worth the cost. So we ended up paying someone to mow the lawn for us. It was a neighbor kid at first, and we ended up getting a landscaper. And I remember my good friend and my business partner, who's also very blue-collared, said, hey, why the hell would you pay someone to mow your lawn? Like, we do this ourselves. Like, roll up your sleeves, get out there, and mow it your damn self. And I was like, yeah, but I'm paying this kid like $60. And in the hours that it would take for me to mow my lawn, because we have a really big backyard, right? And a little push mower, right? The hours that it would take for me to mow my lawn, I could be doing this and this and this and this for my business. And I can guarantee that the task that I would accomplish within those like 4 hours of working my business would create more money than the $60 I'm paying for this kid to mow my lawn. So it's like financially, see what I'm saying here, right? So everything is measured in opportunity cost. And we should be looking at the same thing when it comes to frequency. So the question that you should ask yourself as a trader is this opportunity, whatever the trading signal is for you, is it worth my time compared to other things that I can be doing, right? So understand that trading is an investment, right? It is an investment. If you are going to be a day trader, right? And this is one of the reasons I stopped day trading, you need to invest consistently a certain amount of hours per day into the market. So my day trading day, not counting prep, just my active day trading day was 3 hours. I traded from 8 to 11, right? My prep before was another hour. Let's just count that as well. We won't even count the other stuff like journaling and all the other stuff that you have to do or that you should be doing as a trader. Let's just say that is going to be extra, right? It's not technically part of your work day, but it's like you going home and working on your craft, right? You're not getting paid for it, but it's helping you. But so my day trading day was 4 hours. I did it 5 days a week, right? So that's 20 hours a week. I invested 20 hours a week in the market, right? Now, let's say I have a strategy that is so precise, right? It's so difficult and complicated that I only get one signal a week, right? Now, you can do the math on what you make from that signal, and that will change as your trading career grows. But let's say I'm Akil Stokes. I'm starting off really early in my trading career. I'm trading, what did I start off with? I'm trading like 2 mini lots per. So, and let's say my 1 day trade makes, it moves 20 pips, right? So I made $40 on a trade, right? Is $40 worth 20 hours of invested time if I'm getting one signal a week? And again, this is an extreme kind of example because I would assume you would get more than one signal a week, but you never know. But just kind of to put things in perspective, right? Is it worth 20 hours of chart time, not counting the extra stuff, to make $40? Like, maybe it is, maybe it isn't. There's no right answer. It all depends on what you're worth. It's the same thing if I asked you, like, hey, would you come over and paint my house, right? If I said, hey, I'll give you like $3,000 to paint a room in my house, many of you would probably jump all over that, right? If I said I'll give you $100, many of you would be like, no, not worth my time. But there would be someone out there that needs that $100 that would be like, yeah, sure, I'll do it, right? So it's going to vary per person. But we have to think of the opportunity cost and what is our time worth. We should also think about what is the alternative worth. And this doesn't just go for frequency, but return on investment. I just came back from a board meeting today with a nonprofit that I'm a part of. And we've really for the last 5 years, really for the last 10 years, we've been trying to get them to overhaul our investment strategy. And I've told you this story before, but the problem is there are a few active investors on the board, me and one other individual, right? Brilliant individual, right? Organizer for TEDx, right? So he had a chance to kind of meet with the best minds in the business, which is great. And then there's kind of a traditional investor, someone that has worked for, I don't even want to say for mutual funds. He's studied investments, and he has kind of a quote unquote traditional background, safety approach. And then there's just common individuals that know nothing about investing. And our board or our foundation has taken a very safe, don't lose money, make minimal gains approach through a fund. And for the last 10 years, we've been trying to say, hey, we could be making a lot more money than this. And the response is always, well, what about the risk? What about the risk? And we're like, well, there's going to be more risk, but it's still limited risk. And finally, this past year, we've been able to talk to a few people, some really great minds. A great investor who is, he's been on Bloomberg. He's been mentioned in the Wall Street Journal. He is the top investor for, I'm not going to put the information out there, but the top investor for years of a local firm out here. And we finally convinced the board to be hey, we can take a much more aggressive approach and make a lot more money while still being safe. And all it took was showing them studies over 10 years where it was look, this is what our foundation made over the last 10 years. This is what we could have made if we did it this way. And they're like, what? And I'm like, yeah, right? So another thing is opportunity cost with what is the alternative, right? If you are a trader and you're investing, 20 hours a week into the market, right? Remember, this is 20 hours of the week that you could be doing something else, playing with kids, doing something creative, working out, right? Whatever you're stealing this 20 hours because time can't be had back. You're stealing this 20 hours from something to invest it in trading. Let's say you are making a 10% return a year. Return on investment is 10%. Now, hats off to everyone making money, right? Most traders go broke. If you can break even in trading, good job for you. That's a good start. But eventually, once you get to your peak form in trading, you should probably be making more than 10% a year, because here's the deal. If you put your money in a money market, you're going to make half of that by doing absolutely nothing, and you're going to get all the time back. You're going to gain 20 hours, and you're going to make half of your investment. If you just passively invested in an index, the S&P, for example, you're going to make double that on average, more than double than that on average, right? So you're still investing maybe 1 hour, if that, not even 1 hour a week, right? 1 hour a month, maybe, if that, and you're getting double the return. So is it worth my investment of 20 hours a week to make half of what I can make by doing nothing but gain 19 hours back, right? So you have to make those comparisons. And again, there's no magic formula to this. There is, some people just love trading, right? We worked with a trader before where she was actually making less than what she did she had all these other investment tools set up, but the fact was that she just wanted to have control over her money, right? So she didn't put everything into her trading account, but what she valued was the fact that she can control her money, she can control where it was going. And that was valued more than what she was making from this outside service. So it is going to be different per person. And that's why I say it's really fluid on an individual basis. So those are things that you should consider when thinking about frequency, when thinking about return on investment. I'd love to hear your opinion on it, because I am just a man, a great man, but I am just a man. If you have any advice for how you define frequency, what is frequency for you? Feel free to let me know, right? You can hit me up in the DMs on social and let me know. You can leave comments under this video. If you're doing this, I know Spotify, you're allowed to leave comments. I think on YouTube as well. Of course, on YouTube as well, Akil. What am I saying? And I'd love to read through them, and maybe I'll do a follow-up on this episode. Speaking of YouTube, make sure you subscribe to the channel. Uploading a lot recently, usually 2 new shorts videos each day. Quick tips for you, and of course the normal weekly video showing you technical analysis in the market. All right, thank you guys for joining as always, and until next time, plan your trade, trade your plan. Take care.